It is a widely accepted rule in finance. When economic uncertainty rises, the value of gold rises with it. To see that rule in action, look at the late 1970s. The global economy faced double-digit inflation, a weakening US dollar, and severe geopolitical shocks. This chart tracks the result. That climate of anxiety pushed gold to a record intraday high of roughly $850 an ounce by January 1980. On paper, this historic peak confirms the theory. High global fear created high value for the asset. But look what happens after that peak. That January 1980 record became the absolute top. By year-end, gold dropped to $590. By 1982, it fell below $400, grinding lower through the decade. In plain dollars, it took 28 years for gold to reach that $850 price tag again. If fear drives gold prices, we need to understand why the crisis of 1980 resulted in a multi-decade collapse. We can find the answer by looking at how gold actually behaved during the initial shocks of the two biggest financial panics of our lifetime. In 2008, as the banking system was breaking, gold didn't rise immediately. From its March peak near $1,000, it dropped over 32% by October. When acute panic hits, investors need cash to cover immediate shortfalls. They sell what is easiest to sell, and in that rush, liquid assets like gold get pushed down with everything else. We saw this same pattern repeat during the lockdowns of March 2020. In just 10 days, gold fell roughly 13%. During a crisis, the initial market reflex is often to liquidate gold, not hoard it. Despite those initial drops, gold recovered in both 2008 and 2020, finishing both years higher. These recoveries occurred alongside a specific shift in monetary policy. In both instances, central banks were aggressively cutting interest rates toward zero. Now look at 1980. Instead of cutting rates, the Federal Reserve hiked interest rates toward 20% while gold was falling. At the same time, global central banks were operating as net sellers of gold rather than buyers. The soaring yields on cash and a lack of institutional buyers created mechanical pressure that easily overpowered the fear in the headlines. Today, the market is facing a checklist that looks remarkably like 1979: high inflation, geopolitical shocks, and gold at record highs. But there is a structural difference in today's market that did not exist in 1980: the behavior of central banks. This chart tracks the scale of that shift. Central banks have been massive net buyers, accumulating more than 1,000 tons a year since 2022. This continuous institutional demand provides a layer of support that the 1980 market simply did not have. These historical patterns are not a crystal ball. This data cannot predict the future or guarantee a price floor for any asset, but the history does show that focusing entirely on headline panic is an unreliable indicator for long-term value. To evaluate a crisis, we have to look past the fear and focus on the mechanics driving the system in the background. Shifting that lens means tracking the direction of interest rates and the behavior of institutional buyers. That is what we track here every day at METLYZ.